Hey everybody, we've got the 2026 tax brackets and I want to make them as useful as possible for you. So here we go. All right, let's jump in. We're going to start with married couples. Married couples, it's the same percentages, 10%, 12%, 22, 24, 32, 35, 37. That's the standard federal income tax brackets. Now, what the IRS does from there is they expand, they grow for inflation each of the buckets. So from zero to $24,000, you have 10% taxation. 24 to 100,000 is 12%. Then you jump into the 22s. Notice that's a big jump. That's 10% taxation. So in retirement, we're always paying attention to this. So 22 is up to 211,000, 24 up to 403. You jump over that, then you're in the 30s, another big jump. And that taxation goes from 32 to 35 to 37. Now, the other thing that we've got going on here, spin around and look at it this way, we've got the standard deduction. That is set at $32,200 for a married couple. If you're over 65 or blonde, you automatically get 60. I said blonde, sorry, blind. You get an extra $1,650 each. Okay, so if you're married, you get two of those if you're both over 65. And then that new senior bonus deduction, we've got an additional 6,000. I hold that out separate mainly because it's important to understand there's a big phase out on that. So some people are going to qualify for it, some people aren't. The over 65, 1,650 is automatic, whereas the $6,000 is not necessarily automatic. And that'll be each. So married couples can get up to 12,000. I think the phase out begins at 150,000, but I leave that for a different video. All right, here we go. So I'm going to make these useful for you. We'll bring it all together at the end, but I always take this standard deduction and assume you're all going to get it, right? Because the vast majority of people that try to itemize don't have $32,000 worth of things to write off. They've limited our itemized deductions so much, but that almost everybody is taking the standard deduction now. So I recreate these tax brackets and I put a zero tax bracket in there. So instead of from 0 to 24, you're paying 10, that's not true, right? Because you have a standard deduction of 32, that means the first 32,000 is not tax deductible. And if you're over 65 and qualify for the new senior deduction of $6,000, your standard deduction as a married couple, two at 6,000, two at 1,650, that's $47,000. That's why that gimmick of your Social Security is not going to be taxed. That's why that gimmick came about. They're still taxing your Social Security exactly the same as always. But the reality is the first $47,500 of your income, if you're over 65 and qualify for the new senior tax deduction, is not taxable income. So that's a pretty cool little bonus we've got there. Then from 47 to 72, you're paying 10%. And then from 72 to 148, you're paying 12. So there's your hint right there. Try not to cross over $148,000 as a retiree, and you will stay as efficient as you possibly can be. You jump over, even a dollar over, it's just that dollar that you're paying 22%. Okay? But that's a 10% jump. So we always do our best to get tax advantaged income if you need more than that, and control our taxable income and try to keep it at that 148 or below. Depending on what part of the country you're in, it's a little hard for New Yorkers to live on 148, but here in Arizona, that's considered a very enjoyable retirement budget for sure. The vast majority of retirees envy that. All right, so now let's go to a single couple. Or a single person. You can be a couple if you're single, it's fine. Same tax rate, same percentages that you're going to pay. But the brackets are just smaller. And essentially, they're just half. Essentially, the first early ones are half. The rest of them, it starts skewing drastically. But that being said, 0 to 12 is 10%, 12 to 50 is 12%, 22 is up to 105, 24 is up to 200. You go over 200 and you're going to start paying the 30s. Okay. So we translate that. We've got a much smaller, whoops, wrong way, this way. Much smaller standard deduction of 16,000. Again, do nothing, you're going to get 16,000 worth of tax-free income. If you're over 65 and single, you get 2,000 extra and a senior bonus of $6,000. So we translate all that. If you qualify for all those deductions, you got $24,000 of tax-free income. Then they start taxing at 10%. From 24 to 36 is 10, and 12 is all the way up to 74,000 as a single person. Okay. 22 is up to 129, 225, so forth and so on. All right, so let's take a look at this. The first thing I want you to do, and again, I am typically working with people that are heading into retirement or are in retirement. So the first thing to make these things useful is, one, translate it. Add the standard deduction into the tax brackets, which I've done here for 65-year-olds that qualify for that extra senior deduction. Okay, so if you don't qualify for the extra senior deduction, take $6,000 away from this each. If you're married, that's $6,000 each. That's $12,000 you would subtract from here, whereas over here you do that for just once. Okay, so I also put these big thick lines between 12 and 22 and 24 and 32. Those are our big jumps. Okay, go and add up your income for the year. You should be doing this every November. Okay, this will help you make decisions and help you be more tax efficient. So add your wages, and if you're self-employed, your profits up. Okay, if you don't have any wages, you're not self-employed, boom, that's zero, done. 85% of your Social Security, because at most 85% of your Social Security is taxable. Okay, if we live in these lower tax brackets, 10 and 0% tax brackets, then probably your Social Security may or may not be taxable. It's a very sensitive part of our tax return. Sometimes it is, sometimes it isn't, but at most 85% of it is taxable. Add any pension income you have, any IRA withdrawals, any interest you earn throughout the year, dividends, capital gains, those are all important. Add all that income up and find out where you are in this tax bracket, because everybody's different. And this is why every scenario is different when it comes to tax planning. Okay, so once we've added that up, we have perspective. We know what your situation is. I'm also going to know what we can and can't control. For instance, I'm not going to call your pension and say, pay them less. They don't need that income and they don't like paying taxes. We're not calling Social Security, reduce the Social Security. No, those are things we can't control. You know, you want to maximize that. You want to get the most that you can out of it. But the reality is we can't control it. Right? So once it's triggered, once it's coming in, we're not going to reduce it. We can't manage the taxation. We can manage the interest we're earning and where we're earning it. We can manage the dividends and capital gains, because these all come from choices of investing our money. Okay, so that's important. Certainly IRA withdrawals, we can manage these things until you get to required distributions, and then you're forced to take a certain amount out. So anything in the 0 to 12%. So meaning when you add all this up, 85% of Social Security and all other forms of income, when you add that up, if you're less than 148 married or less than 74 single, good job. But for instance, if you're a married couple and it adds up to $100,000, guess what? You have $48,000 worth of wiggle room. At 12%. You can choose to pay 12% on some of that IRA money. Okay, so we become a little more proactive. Not everybody, but most people should be more proactive when we're in this zone, 0 to 12% taxation. The next part is the gray area. For some people, this is low taxation. For some people, this is an opportunity. For others, it's high taxation, defer. Okay, so I call this the gray area. It's situational. It's also based on your heirs. There's a big difference between a married couple with one heir, like myself. I've got one daughter. Everything goes to that one daughter. Who's going to pay less taxation, us on a married tax return or her on a single tax return? So I try to be as proactive as I can. I hope that she's successful. I hope that she gets married. I hope, but I'm dealing with reality. She's a single person inheriting everything no matter what. So the reality is I need to consider that when I choose to be proactive or not. Whereas somebody else might have 10 beneficiaries. Somebody else might have half the money going to charities. Somebody else might have 100% going to charities. Everybody's different. And that all plays into our choices here. So that's why there's a gray area. The next part is the high taxation. If you're in the 30s, just defer, defer, defer. Most likely your heirs or somebody else is going to pay less taxes than you. That's just the reality of it. Or you're still in your working years and you'll be in less taxation later. So by having this chart here, this look of our tax return. So again, this is 2026's. I have this for 2025. I use it all the time when making decisions on portfolios and creating income plans and choosing to do Roth conversions. This is such a useful way to look at our tax bracket. So when you look at this, you want to fill your bank account annually. If you're in retirement, don't just pull from your accounts willy-nilly throughout the year. How are you going to manage the taxation? How are you going to make good choices? The best way to do this is fill your bank account for the upcoming year, spend the bank account, refill it once a year. So by looking at this, I know I had this much in transactions this year, this much income, taxable income this year. So let's say it's 100 and I need an extra 40 grand in my bank account. Hey, I might go pull it from my IRA because I'm only going to pay 12% taxation. And if there's one thing you've learned from my videos, when you look at that IRA, you're always saying, how do I get this out at the least amount of taxation? That's what you're always saying. And if you have an opportunity to get it out at 12, you get it out at 12. Hence the Roth conversions, right? You want to take care of your own needs, especially in retirement first. So refill that bank account for your upcoming year. Then you need to start considering Roth conversions. From people that are being proactive, getting that money out at the lowest taxation they can. You want to fill that 12% tax bracket. Great. Some people even fill the 22 and 24. You just have to start watching out for IRMA. IRMA is going to come after you. That scary shadow tax. I have videos on that too. And then there's tax loss harvesting for those of you that have investment accounts that are not IRA and not Roth. They're the brokerage accounts, those after tax accounts. You want to start tax loss harvesting. Certainly, if you're in the 12% tax bracket or less, there's opportunities to get dividends and long-term capital gains out at zero taxation. We want to take advantage of everything that we can as efficiently as we can. Good advisors are going to understand taxation and be able to make you a lot more efficient. This is how they earn their keep. Undefer, I love that. I don't think it's a word, but undefer, right? Some people get sold on an annuity as a deferral, tax deferral. Well, at some point, you have to undefer it. Right? Somebody's got to pay taxes at some point, whether it's IRA money or annuity money. You may consider filling up that 12%, paying some of that taxes at lower tax rates. So again, controlling how much you're paying in taxes instead of being a victim. Don't be a victim. Control things proactively. And then for those of you still working, are you saving via Roth or IRA? I know the younger generations, they get sold the Roth idea, and it's come up quite a bit now because of all these new laws and bills and things that are being enacted by people that are so out of touch and don't understand anything. So here's the reality of it. If you're in your prime working years, Roth is not your best friend. I know it's great to have that really long time of deferral and compound growth and complete tax-free. That's great, but at what cost? you're investing, 60 cents on the dollar because you're paying high taxation to get it in there. I'd rather have 100 cents on the dollar in an IRA growing and manage the taxation when I'm pulling it out in my lower taxation years, because the vast majority of people in their working years make more money in their working years than they do in their retirement years. I've got tons of clients, very successful in the 20s and 30s, certainly in their prime working years in the 30+% tax brackets, that are now really enjoying their retirements in the 12% tax brackets, my parents included. Yes. Do I know people that are actually making more in retirement than they were in their working years? Yes, it is an anomaly, though. It does not happen very often. It usually entails very large pensions and things like that. So we got to make sure that we know what we're saving and why we're saving it. If you are in higher tax brackets, defer, defer, defer. That means save via IRA, traditional pre-tax. Whereas if you're in lower taxation, great, push into Roth as much as you can. I have no problem with that. So it's important that we understand these parameters. If you're paying for advice, this certainly should be a big part of it. This helps us make proper choices and make you as efficient as possible. And advisors need to understand taxation. They may have to be careful and dance around talking to you about it, but if they don't understand it, holy cow, they're not earning their keep. This is how you truly can make a difference, especially in the retirement years. You can be a lot more efficient, and it makes a big difference. We're talking a lot more than the fees these advisors typically charge. So I hope that helps. I hope that gives you some insight. I hope that makes these tax brackets useful. If you're worried about state taxation, go look at the percentages you're paying in some of these states. It's very low compared to federal. You should really be driving your decisions based on federal taxation. There's a couple of states with higher taxation, but I just say move. Why live there? All right, everybody. I hope that helps. Go to yourinvestmentcounselor.com to schedule a free meet and greet with me, the actual me. I am real. Always happy to talk about this stuff. And you can jump on Your Investment Counselor and match up calendars and schedule a free meet and greet. If you haven't found our full classes, I do full educational classes every single month. FPFEAZ.org. That's a nonprofit organization I run and educate through. FPFEAZ.org. Certainly subscribe, share, like, do all those wonderful things to help us. I hope to see you soon. And we've got new videos every week. So that's why you got to subscribe. Thanks again. We'll talk to you soon.